Edna, what a great start to the day.
Good to have you back. I think we have the action people on the panel. They're here. They're committed, and I think they're also sending out a few warning signs.
Tell me, what was your takeaway?
I just am so encouraged that the narrative has shifted. Remember, not that long ago, it was very difficult to get the CEO of a bank and fund managers up there to talk about this. Whereby now, I think the reality of the decarbonisation message is out there, the opportunities that are there within this, and I just think we've stood back and looked at that great direction we're all heading in and say, actually, we need to look at the journey a little bit more.
Fantastic. We have definitely come a long way since my days in banking, sitting on the trading floor of UBS when I was one of the few women. And on that note, I'm particularly pleased with the composition of my next panel, as you'll see in a moment, Edna.
And I think many people mentioned it there, the ESGs, we'll make sure the SDGs are put in place. And,
exactly.
It's something new, perhaps, if we look back on pictures of a financial conference 5 years ago. Probably your panel looks a little bit different than things
exactly.
did then.
Let's bring them up now. Thank you so much, Edna. Right, we're going to move now from the shift to look at the shift in financial institutions' strategy of how they approach ESG investing. Let's bring up my panel. I will introduce them to you as they come up. Welcome. Welcome. Thank you so much. Come on, let's give them a round of applause. Welcome. Well, I'd just like to note one more time, composition of this panel, looking pretty fantastic, isn't it?
It is.
So we know that lower and middle income countries have been penalized by investors avoiding certain investments. As we shift to a more proactive approach, engaging with portfolio companies to impact change, we're going to ask what effect this approach is having in emerging markets. So with me now to discuss moving from divestment to engagement, very pleased to have
I was more saying it can be
on
win-win
stage.
for
Got
the developing
Edna
world
in the background there, but we've very pleased to have
but I
Rania
love the way you
Nashar,
brought that
Head
up
of
because
Compliance
absolutely,
and Governance
and
Divisions,
that was good to actually
Saudi
say
Arabia's
directly, otherwise
Public
we'd be out.
Investment Fund. Also the CEO of London Stock Exchange, Julia Hoggett, thanks for coming along. Very pleased to have from BNY Mellon, Corinne Neal. We have Global Head of ESG from PGIM, Eugenia Jackson, and Head of Social Impact at SoftBank, Catherine Lenson. So let's kick off briefly, if you will, from where you sit. How does this transition from divestment to engagement in ESG investing, how's it going? And I'd love to hear one challenge and one opportunity. Corinne, let's start with you.
Well, biggest challenge, I guess, to make decisions is to obtain the right data. And there is both too much data available. It's not using the same definition, so it's very difficult to navigate through it. And the investors don't really trust what is available in the market. So that's the biggest challenge. Biggest opportunity is to leverage on technology to navigate through this data and to align it to investors' specific own goals. And we have the technology today to be able to achieve this, so that's the good news.
Tell us a little bit more about that technology. What does it enable you to do?
For instance, at BNY Mellon, we use natural language processing to navigate through 600 different data sources that are chosen by investors to help them align their own definition of sustainability with their own goals, with the data that is available in the market. And very often the data is also collected by investors themselves through engagement, which leads us to today's discussion.
All right, excellent. Catherine, what about you? Where do you sit in this? How do you see this transition from divestment to engagement?
Yeah, so for us, the challenge and the opportunity are really one and the same. And at SoftBank, we invest in technology companies with radical ideas about how they want to transform the world. And for us, the challenge is about making sure that for us and for the industry in general, we're able to put investment dollars into the hands of diverse founders. Diverse meaning women, diverse meaning otherwise underrepresented in the location that they're founding companies in. And so for us, that's a challenge because if you look at the data, something like 2% of venture funding in Europe, for example, goes to women. Something like 1.6% last year went to non-white founders.
Still.
Staggeringly awful numbers.
Right.
A challenge. It's also an opportunity because we know that these companies and these founders represent real investment opportunities. They're building products, they're building technology that the market wants, that consumers want. We'll soon have a situation where the US is a majority-minority country, and yet still the technology that we use that shapes our everyday is being built by founders and funded into companies that, for the most part, don't look like the people who are consuming the technology. That's a unique opportunity commercially.
So what percentage of the companies you put money towards are run by non-white, non-male leaders?
So we have two different approaches to this. And in our late stage fund, the Vision Fund, we're very focused on making sure that we do focus on that. However, we're also trying to influence funding at the earliest stages of the capital cycle. Because by the time you get to a growth stage fund like the Vision Fund, you need the system to have done its work at every point of the funding cycle to be able to write the growth stage checks. And so we're very proud of the work that we're doing at the earliest stages of the capital cycle through a couple of funds, the Opportunity Fund in the US, Emerge in Europe, which really are about fixing the issue at the earliest stages and getting that capital into the hands of diverse founders, and then following them through their journey so that they can go on and become Vision Fund companies. And that's our aspiration.
Fascinating. Let's hear from Rania. Tell me where you see this, the conversation from the view of the PIF in terms of divestment versus engagement.
PIF really understands that being engaged with its portfolio companies and investment is the right thing to be done. It's not about divestment, and because divestment will not help the overall economy. You're just moving the investments from the hands of the public to more private hands where there's no transparency, no monitoring, and this will not help the overall economy. So what we look at is more of not only the destination, but the journey. Companies, including PIF portfolio companies, are announcing their net emission reduction, but it's not about that destination, it's about the journey, because there are multiple paths where we go through this destination. And in PIF, since we operate in Saudi Arabia, which is considered an emerging market, we have to make sure that we're doing the right decision the first time, because action on climate change cannot be overstated. But we should also not ignore the consequences of these decisions on the economy, on the social, and on the financial part. So that's why we approach the ESG through multiple aspects, through partnership, through creating the right platforms, and sponsoring initiatives and events. So as part of the creating the platforms, PIF has just announced the voluntary carbon market for the whole MENA region, where we are trying to bring in investors and institutions toward helping them to achieve their carbon reduction targets. Also, what we have done in partnership, PIF is one of the founders of the One Planet Sovereign Wealth Funds steering group, which is a network of multiple sovereign wealth funds, asset managers, and private equity that holds assets of more than $30 trillion. We are working together and collaborating and understanding the risk and the challenges and the opportunities for the climate change. Also, as part of being the investment arm for the Saudi government and one of the main economic catalysts to achieve the Vision 2030 targets, we are supporting all the initiatives locally, regionally, and globally, such as the Saudi Green Initiative and the MENA Green Initiative.
A lot of going on in there, and a lot of complexity, which we might come back to. Interesting, you mentioned the voluntary carbon market as well. Julia might touch on that in a moment. Yeah. Before I come to you, Julia, though, I want to get Eugenia in. Let's come back to the title of this talk, and it's about divestment versus engagement. Rishi Kapoor from Investcorp said earlier today, exclusion is a blunt instrument. So is there really no role for exclusion anymore, Eugenia.
Thank you so much, Edie. And I would just say, before I move straight into the topic, is that at PGIM we invest across all major asset classes, in private and public markets. And when it comes to this proactive shift to proactive ESG approach, the real change that we've seen over the last couple of years is our investors, our clients, are interested in achieving positive environmental and social impacts on top of achieving financial returns. So the discourse has moved from is it ESG versus financial performance to how we can use, so how can we achieve the desired financial returns whilst also maximizing the positive environmental and social impact. I think this is a very, very important move. And coming to the question, is there a role for exclusions? I would say that, first of all, if we look at the ESG strategies out there in the market, we will see that actually exclusionary approaches are still very, very dominant. So it's there. Now, why is it there? Firstly, exclusions do allow our underlying investors, our clients, to express their values and their sustainability preferences through their investments. It is a blunt tool, but it can be effective if you want to channel your particular values through those exclusions. The second reason for non-investment, let me put it this way, is also a part of risk management, because some of our clients do see the role of exclusions as, for example, giving them ability to consistently manage certain risks, such as climate transition risk. But when you come to divestment versus engagement, I think for an active manager, both are very useful tools. Because engagement, of course, is going to be a preferred option for the vast majority of investors. Because if you have a good engagement, if you achieve the positive change that your engagement was meant to achieve, and if that positive change also increases the value of your investment, well, that's a win-win. That's actually a perfect situation. But to be able to achieve that, you need a certain alignment, right? You need to have the engagement objective needs to be aligned between the issuer and the investor, so both needs to be on the same page in terms of what they need to achieve. Also, importantly, the time frame for making progress towards that objective also needs to be aligned. When you see that there is a misalignment, so investors maybe want too much or want too fast, or the issuer is not willing to commit quite to the same point, you have to start considering what are the options. Because for an investor, ultimately, for an asset manager, we have our clients. We have fiduciary duty to our clients. They have their own underlying objectives, and we have to deliver on those objectives, both from the financial returns perspective and from the ESG perspective. So if we are seeing that either, on the risk management side, we are not getting there, we are not mitigating risk sufficiently, then why would we stay as an active manager in that investment? And finally, if on the ESG objective side, if we are not achieving our clients' ESG objectives, then, again, exit is, or non-investment is something that, we should be able to use. So I would say there is still a role.
Okay, so it's complex. It's not black and white. That's what I'm getting here. Julia, tell us what role stock exchanges have to play on the path to net zero.
I'd say it's huge. I'm a former regulator, and I think I said at FII in Riyadh last year, you'd expect me to believe in pipes and plumbing, but I genuinely do. And I think a lot of it is about how we make sure that all the pipes and plumbing in the system actually direct flows in the way that they need to go. And I talk about it that money may make the world go round, but data shows it where to go. And this point was made that we don't yet have the right structures around all the data that we need. So we think about it through, I'd say, 3 or 4 lenses. One is financing the green economy. The other is financing the transition and being really outspoken about our role to finance the transition as well as the green economy.
And that means engagement.
That means engagement. And I talk very publicly, to steal from Gil Scott-Heron, about the concept that the transition must be televised. In other words, we actually need to have this conversation out loud in public, and we need to be measuring this progress that we make. And the public markets are a superb place to do that, and therefore the public market should be the last place that is saying that the transition should be happening elsewhere. The next piece is that we need to make sure that we have the data and the rule sets to support that. I think COP26 went a long way to producing rule sets that are much more standardized, but there is still further that we need to go, and there's more trust in the data that needs to be generated. I think that is absolutely right. The final piece is actually advocacy. We do set rules, and we can also influence and try to support how rules are set around the world, but we can speak out as well. So we can actually, and one of the things I feel very passionately about, is making sure that we speak out for the complexity of this discussion and recognise that actually a lot of the things that we're deploying today, we may find in 2 or 3 years' time are not the optimal solutions to get us to net zero. We will make lots of mistakes. If this was easy, we'd have done it. And therefore, we can't reduce this to binary yes-nos and to tweets. We actually have to have a system that recognises the complexity. And calling that out and being an advocate for the complexity, I think, is an important thing to do. And it doesn't just apply to climate transition. I think we feel the same duty when it comes to representation of diverse communities as well. And obviously, the rule sets in the UK are increasingly focused on that in terms of expectations around representation of listed companies. And as a female CEO of the London Stock Exchange, you would expect me to think that we shouldn't just have International Women's Day, we should just have every single day of the year.
Hear, hear.
And advocate for that representation and the importance of it, but also the value of it. So to me, the most powerful thing we can do is not only create the change, but be a voice and a beacon to advocate for it, because it's possibly easier for us as a convener sometimes to be outspoken than it is for other parts of the community.
You mentioned too complex to be done in a tweet. I think quite a lot of things are too complex for 360 characters or whatever it is. Let's focus on what else you might need to apply ESG metrics, Corinne. What do you need in order to play a more active role?
So it starts by defining goals. That's really important. Not everybody has the same goals. And actually, we realized that at BNY Mellon by asking our clients, because we have clients all over the world, in the Middle East, in emerging markets, in EMEA, everywhere. And they each have different sets of goals. There's always a combination of financial performance in it. There is some element of risk. There might be other financial elements like maturity, duration, but there's also values, and values are very specific to individuals. So the first thing is to help investors express their goals, because if you have that, you can better align capital flows to the goals of investors. So the first most important thing that is missing today in the markets is that alignment and helping investors express those goals. As I was saying earlier, now we have technology. We can actually pick up information from individual preferences and match them to investments. And actually in EMEA, the regulators are moving in that direction. They're saying you have ultimately to make sure that your products meet the goals of the investors. That's exactly what they mean. And so you need to find a way to simplify the process, because it can be overwhelming to match the investments and investors. And that will bring more investments in emerging markets. So that's really critical element that is currently missing.
Anything to build on that, Eugenia?
I would say yes, certainly, and I totally agree with what Corinne just said, but I also think that to be able to live in this world where we have very different, diverse goals and ESG objectives, and we as asset managers have to fulfill those different objectives, but to make it understandable to the outside world, to help investors, particularly retail investors, to make informed choices, we need a much more agreement on the definitions of ESG. So when we say ESG, when we say sustainability, when we say impact, what do we actually mean? We need some consensus around the taxonomy, the naming convention, the taxonomy around products. And some of the regulators are doing it. We know SFDR in Europe, but it's not resolving it yet. We're only realizing just how much confusion we have in this market. So I think that's an essential step. And the second I would mention, going back to the regulation, we do need a well-thought-through regulation in this space. We need a regulation that is paced at the right and sequenced, very importantly, in the right way. So first we go for disclosures from corporates, then it comes to investment managers, how we collect that information, how we translate it into analytical tools, into sort of creating different solutions, focusing on different investment objectives of our clients, and then sort of going to asset owners where they can then present what they've been doing at their holistic portfolio level to their underlying investors. I think that's what we need to be a lot more active in this space.
You mentioned the different words in the taxonomy, and I think that's so important, because what we've seen over the last few years is actually all these different conversations that used to happen in silos converging: CSR, diversity and inclusion, SDGs, equality, growth, and now they come together, and sometimes it can be quite difficult. Catherine, what do you think the key drivers are behind responsible investment decisions?
I think what you just said is so interesting and really important to dig into for a moment, because the different acronyms, and my word, are we acronym heavy in this space, but the different acronyms actually sometimes are getting at slightly different angles. So CSR is, traditionally about a corporate doing the right thing. It's about charity and philanthropy, and it's often about giving away money. And I think what sometimes we get wrong when we talk about the ESG space, and for us this is very important when we think about our two impact-focused funds, so the Opportunity Fund and Emerge, it's really important that we talk about these as the unique commercial opportunities that they are. This is not a CSR project. I spent the early part of my career thinking about diversity from a people lens. This is equally as important from an investment lens as it was 10 years ago and continues to be now on the people side. This is about diverse teams producing better commercial results. This is about diverse founders building products that better serve a diverse consumer base. And so, depending on who I'm talking to, I tend to come at this from one of two angles. Of course, there's a social angle. Of course, it does the right thing. Of course, we want our children to grow up in a world where products are being built that serves them. We talked a moment ago about gender. Let's talk about gender for a moment. Why are so many women's health tech products that come on the market, or so many health tech products not focused on women's health? Facial recognition, for an example, gets white men's faces right 100% of the time. Typically gets non-white women's faces wrong 35% of the time. Extraordinary gaps. So of course there's a social angle. Of course we want to do the right thing. But to another audience, this is a unique commercial opportunity. There are opportunities to make significant money in this market, and by the way, it has the byproduct of doing the right thing at the same time. Why would we not do that? It's win-win from every possible angle.
It's not just facial recognition, it's vocal recognition. Actually, for my podcast, my co-host is Hispanic, and I can't even tell you sometimes when I read the transcripts the words that it's changed her words into. Rana, you've spoken about the need for governance to really drive climate action. So tell us about how the PIF in particular is implementing its governance structure in order to serve its ESG integration plan.
Actually, it all starts with the G, with governance. Once you have the governance right, then the S and the E part will naturally come. So the governance means that we have to really understand how our investments, how our companies that we own are taking the right decision first time. So it starts with the board, with its committee, and ensuring that our investment teams are heavily and continuously engaged with those companies to understand the risks and opportunities that relate to all matters, including ESG, and ensure how this is embedded within the companies. As we all are saying here, that there is the challenge of the definitions, of the taxonomies, of doing the right thing, of setting the goals, how to pace the ESG within the portfolio companies. So that's why we have created the platform for the overall ESG, where we monitor and ensure that our companies are reporting to us on their ESG goals. It's very key in our investment decision process that ESG is looked into as part of all our investments, because here we are talking about the future. We are not talking about de-risking or decarbonization of our portfolios now. It's about, the future. So how we help in the transition, how we create the right awareness. Once you do divestment, it helps in the creating the awareness, but it does not help in the overall impact that PIF is sought to have. So therefore, we make sure that the decision-making process, ensuring the right votes and the right board seats, we secure in the companies to help in driving and influencing the decision.
Interesting. So, Julie, let's come back to the topic of today. It's really all about getting money to emerging economies. What role does the LSE have to play in moving capital from high-income countries to lower and middle-income countries?
The London Stock Exchange has traditionally been the most global stock exchange in terms of financing emerging market economies, and that aspiration is not going to change, certainly not under my watch. But fundamentally, the other thing is we need to start doing things differently. That sort of comment attributed to Einstein that he never said that actually that sign of madness is doing the same thing over and over again, expecting a different result. Some of the things we need to do is think about how we actually change the way capital flows and what we value. The transition to net zero means that companies in the global north have a massive need to have the tools by which they can get to net zero. The voluntary carbon markets provide a great opportunity there. For those who are unfamiliar with the voluntary carbon markets, you can't have a voluntary carbon credit unless you're doing an investment in reducing the amount of carbon in the atmosphere that is genuinely additive. So building a wind farm off the North Sea with a viable offtake price doesn't get you a carbon credit. And therefore, all of this activity is stuff that would not otherwise happen that will get us and contribute to getting us to net zero. We have focused at the London Stock Exchange on building a voluntary carbon market to finance those projects. Not to trade the actual credits, there are lots of other people who want to do that, but to actually direct the financing into those projects. It will enable funds to be created that can pay dividends as cash, but actually dividends in specie as voluntary carbon credits. In the UK, we now have mandatory TCFD, so all the listed companies have to disclose to that standard. And as David was saying this morning, we want to get to a point where there's mandatory transition plans by 2023. And therefore, you can have a grown-up conversation about what the hard yards are that companies are actually doing to decarbonize their supply chains and their production, and then that bit that they can't yet solve for. If you produce shampoo, and your Scope 3 emissions include the amount of energy that we all use when we have a shower in the morning. And you're
Scope 3 meaning the things that you aren't under your direct control.
Exactly. Yep. And you don't control the fact that the energy is produced in coal-fired power plants, then that isn't something you're going to be able to directly impact yet. But you could invest in carbon credits to address that piece of your emission target. And therefore, it's an illustration of how much we can actually think about shifting what is valued and therefore where cash flows. A huge amount of the projects where that sequestration will take place will be in low and middle income countries. One of the things that really personally matters to me as a former development sociologist is actually that we maximize the returns to the global south of those projects. If we nickel and dime and compete on price, on the carbon price, the people who will benefit will be the global north. The people who will lose out will be the global south. And so it's a really interesting inflection point in the design of the carbon markets as to how we do this. But our view is that our primary job is to direct capital into those projects to make sure that we actually get to net zero. And that is, as I say, doing something very different. It's not a market that we've traditionally had, but it is part of how we get to what my aspiration is for London Stock Exchange, which, as my colleagues describe it, is 8 letters, Julia, but really difficult, which is this concept of ESG as BAU. At the moment, an awful lot of flows into the green economy and into the transition are bifurcated. They're small subsets of the total flows that go on in the market. Actually, we should get to a point where everybody can evaluate every asset through that lens.
Okay.
And that's the ultimate aspiration that we have at the Stock Exchange.
Running very short of time. We've got to get to what happened to Tesla, Corinne. Pioneer in electric vehicles, getting dropped from the S&P ESG rankings, leaving ExxonMobil. Tell us why.
Thank you for giving me the trick question. I think you answered it at the beginning, actually, because the world of ESG is not black and white. It's shades of gray, and it means you really need to have all of the information underneath those decisions. And there are many aspects of E, of S, and G that will have been combined. And actually, it's more than one metric for each of those categories. And for some aspects of the categories, maybe Tesla did better. And for some aspects of the categories, they didn't. And as a result of that, whoever combined all of those together based on their own methodology decided that the ranking was against them. It's important also to realize that very often decisions are made as a function of the construction of a methodology or an index. There are certain categories of industries that have to be part of an index. As a result of that, you have to find a candidate, although it might be subject to questioning. So this is simply a matter of finding the right underlying information to support the decisions. And under that lens, you can explain the decision.
All right, thank you. Very quickly, portfolio performance. How's it going, Catherine?
So I think here we come back to what we've been talking about. These assets are truly investable. And we, in our opportunity funds, we see some very, very strong performance. We see companies that we've invested in that have gone on to raise capital from some of the top names in the venture world. We see exits. We see really strong product development. And I think that's exciting because I think the more we see that, the more we see the broader investment world outside of pure impact funds looking at those. That's ESG as BAU. That's how it should be.
Perfect. I'm going to give the last word to Rania. One thing you want more from governments to encourage this money to flow to emerging markets.
Incentives have to be created to help companies, whether public or private, toward the transitioning, as well as we want a real transparency and monitoring to ensure that there's no greenwash, no pinkwash, no any other wash. So the incentives, the disclosures, and the monitoring.
Don't wash your reds with your whites there. All right. Thank you very much to my fantastic panel. Let's give them a huge round of applause, ladies and gentlemen. Thank you.